Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. November saw a record number of new ETF product launches and a near-record month for inflows. 2023 was the year for actively managed ETFs and for short-term bond ETFs. Billions flowed into money market-like ETFs to capture those 5% yields. Will that continue into 2024? Should investors start moving that money back into equities? Let's talk with Ben Slavin. He's the global head of ETFs at BNY Mellon. Andrew McGorman is the managing director at Wallach Beth Capital. Ben, BNY Mellon, you're the largest asset service provider in the ETF industry. You see all the flows, $1 trillion into money market funds in 2023. I think we're at $6 trillion right now. This end of the year rally back into stocks, are we seeing flows back into equity ETFs? Are people putting their money where the market is going?
Well, look, that's exactly what we saw here in November. You saw that enormous cash pile up go into money markets, and ETF flows were muted. Then November comes and we started to see that money really come back off the sidelines. You saw almost $100 billion in flow into ETFs. And again, unlike the beginning of the year where we saw that flow going into fixed income, especially at the short end of the curve, you saw some selling in fixed income and a large piece of that money going into equities for sure.
Andrew, some of the big trades this year do seem to be reversing. $94 billion in inflows in November. But I noticed something very interesting here. We had $94 billion in inflows. Year to date, $460 billion. Here's the new numbers here. That's just shy of $500 billion, where we would consider it significant. But look at this, outflows from ultra short government bonds. $7.1 billion. There's been inflows all year into that. Yeah. This month, this is for the month of November, outflows of $7.1 billion. I wonder if that is start of a trend here.
I think it shows you some confidence in the market. Just look at the general economy. The spending is starting to ease up, like on the restaurant and retail level, and then that should be the top. The market lags the economy. We know. The economy lags the market. We know that. So I think that's a sign that more money is going to come in. And you talked about the money market funds. How about all the money that's in like the Goldman Sachs Marcus accounts and that aren't even in ETFs? All that is probably money that people took out of equities, even if they're just single stockholders, because of a lack of confidence in the market besides the big seven. And now they're going to start to see, okay, it's safe to get back in the market. They never get in at the bottom, right? We've seen a little bit of a rally. I think that's going to be a big sign for 2024.
The knock on this whole story about all this money on the sidelines and money market funds is a lot of it is like, my mother's savings account. They weren't in stocks to begin with. She just moved it out. Actually, this is a true story. My mother moved money out of her savings account in March. Right. Into
for 5%,
into one-year CDs, and she's not necessarily going to go back into the stock market. So, but there is a point here about this that people seem very comfortable with that 5% yield. But as yields start going down, those money market yields are going to start coming down. Those are short-term instruments by definition. It seems logical that the stock market, if this continues, has got to recapture some of that money. It seems logical.
Absolutely logical. Look, that 5% yield is giving equities certainly some competition. Again, you've started to see that switch. But, really, if you step back and you look at what's going on in flows, and again, it's just indicative of maybe where investor sentiment is going to be going forward. But in November, over 1,800 different ETFs were positive, and over 200 took in, a significant amount of money, more than $100 million each. So it is broad-based. And again, as those money market yields come down, things will change, and certainly there are some investors that are looking to lock in those rates at the longer end of the curve.
That's what I think. I think they're going to get used to 5%. Like you said in the example of your mother, she's used to 1%, now gets 5%. So even some of the younger investors are going to say, okay, I was really comfortable with 5%. You're not going to get it in a money market, but you're all going to get it in a dividend-producing ETF, in one of the option derivative ETFs. You can still get that yield, and I think that's where the money will flow, or even high-yield ETFs, the traditional.
And we talk all the time about flows, and I just want to point out something. Most of the time, flows are noise. I don't pay a lot of attention to them, but $94 billion last month, that was a fairly large number. That was statistically significant. Would you say so?
Yeah, it certainly was. I think it was the 5th highest on record, so that's got to get your attention. Although seasonally, ETFs have done well in Q4. I think, again, here part of it was the markets. The other part, certainly, I think tax loss harvesting is another big catalyst for ETF flows. So certainly there's noise in the number, but it was definitely
tax loss harvesting with ETFs.
Well, look, I think in certain, certainly in the mutual fund structure, you saw many funds, certainly on a relative to ETFs, pay capital gains. And these are situations where it provides investors an opportunity to harvest losses, rotate back into another product, and often ETFs have been the beneficiary to be able to, quote unquote, harvest those gains, and then again, maintain their market exposure. And again, a lot of this seems to happen in the fourth quarter, which makes sense, obviously, given tax planning, but also when these funds make their capital gain distribution announcements, so investors can calculate what their tax liability might be.
How about the bigger index names, SPY, Qs?
Yeah. Using that for tax loss harvesting. Okay. Are investors still piling into big cap tech stocks, or are they positioning themselves for a broader recovery in 2024? I've been noting the RSP, the equal weight S&P 500, has been outperforming the S&P, the market cap weighted S&P, for over a month, and there's been inflows into the RSP. That signals some kind of confidence.
Look, at the whole market rallies, I don't think tech can keep the same lead they had before. Like you have a product like the Pacer Cows, COWZ, right, which is a value play, which offers this dividend. So I think that gap closes. I mean, I wouldn't suggest short tech, long value, but certainly just by kind of reducing your exposure to those tech names, those 7 big names, if the overall market rallies, I think that gap will close.
Yeah, I also think we are certainly seeing a little bit of that broad-based move in terms of flows. Again, gives you some idea of where investors' head might be at. But certainly on RSP, I think it is a concern of advisors and certainly the clients that we talk to that are concerned about that concentration risk in those, at least the Magnificent Seven and some of the indexes, but also those who are looking for ways to potentially place a mean reversion in some of those lower valuations that you're seeing. And RSP is just one little example of how to play that trade.
I want to talk about one of the big trends of 2023, and that was the covered call strategy. It started with JEPI a year and a half ago, but we had some record product launches in active management this year. But as I mentioned, much of it was for these covered call strategies. And those of you who don't know this, you own the S&P, for example, and then you essentially buy call options on it. So in my head, this is not really stock picking, old school active management. You're just doing an option overlay.
It's an insurance. Really is another way to
so why did that take off so much?
Well, I think, again, I'm proud of the ETF industry itself for coming out with these products and bring them to light. It's going to increase option flow, increases people understanding about trading, what they are. What it provides is, let's talk for the audience. In an up market, they're going to lag. So if we rally, these products will lag. They've had a good year because we've been in a neutral market in a lot of products. We've been in a down market in a lot of products. In a neutral market, they're going to outperform.
Because those options you're selling go in the money.
You're selling options out of the money and collecting the premium.
Yeah.
So it just adds.
But if the market goes up,
they're going to have to cost those, cover them at a higher cost, and you'll lose money. So up market, it underperforms. Neutral market, it stays kind of neutral. You get a little bit alpha, but in a down market, it really overperforms. But and a great example. So you have the JEPI, right?
So it tells me that people want to buy some protection. That's what it tells me, essentially. I mean,
correct. The downside, you keep your exposure and you make a little bit of money.
Yeah. What I can't say is certainly, I think you raised some great points. But what I will say is, stepping back, we are seeing a large amount of product development. I think you kind of touched on a little bit. Record product development this year in the ETF industry. 80% plus was active. And then you have a big category, which is these option-based products, which have been a big story this year in terms of new launches. A lot of innovation there. We see a queue still forming, some of it public, some of it non-public. So we are going to see more products like this going into 2024 without a doubt. But it puts a bigger burden on investors and their advisors to really understand what's going on with these products. They are serving a purpose, right, but they are not all created equal. So it could be different in the underlying exposure or the type of protection that you're actually getting or the income that you're seeking, and I think it's very important to understand these differences.
But my point is, I think the reason these things took off because of what happened in 2022. 20% down, and the S&P spooked a lot of people.
Correct.
And they wanted to get protection. These things are sort of natural. I think of behavioral economics. This is sort of the response. Oh, I still want to stay in the market, but I got to protect myself from a 20% down year. I understand that.
You can look at the extreme example.
There's JEPQ, which is the NASDAQ version of the S&P.
Right, the Q. So it's a little bit more volatile. That would be the middle. I think that returned 11% so far this year. But if you look at something like KWEB, right, which is Chinese tech stocks, and then you have CLIP, which is the
so this Crane shares CLIP. This is a covered call version
on K-Web.
Of K-Web. K-Web holds China internet stocks,
now, to
Tencent
point,
and Alibaba, and then it does the same thing. It sells 1 month at the money call options on the full amount of the portfolio.
Correct. And the dividend is...
And these stocks have actually rallied this year, but look, there you go.
Yeah, the dividend is 4% a month. However, you're also down 40% on the stock.
Now, it should be noted that we are not including the dividend in that. That's a price, right?
Correct.
So
that's just the price.
See, that's part of the problem with these showing just the chart.
Yeah.
You should show total return on it. But the point is that it's down because of the performance of Chinese stocks.
Well, the underlying is Chinese tech stocks. So if you wanted to maintain exposure in that and you just weren't writing calls against it, it's a pretty brutal year, right? But you're probably flat to up if you're in CLIP because you're getting the dividend every month from selling calls, which we're never getting called.
Yeah, and again, folks, I want to warn you that is not indicative of your total performance that you saw. KLIP was down, and you really should.
And to Ben's point, you had to really look under the hood to see what asset class. But it's a very exciting product. All kinds of issuers, Simplified, Defiance, Innovator. They're all coming out with these products. Zega, which is a really traditional hedge fund, has these yield max products. They're doing synthetic longs in Tesla, and those are getting more attention than the single stock Tesla ETFs.
Yeah. So the hottest products this year were the short-term bond ETFs, the actively managed call strategies we just talked about. How about 2024? Let's spin this forward. Is this going to continue into 2024? This is the hard part, folks. It's really hard to figure out what the hot product's going to be next year. Any thoughts?
Well, look, I think I sort of alluded to at least one. I mean, certainly we are absolutely going to see more of these option-based products come to market. We see it in our own book. I can also tell you that, without a doubt, there's going to be more attention paid to actively managed ETFs. We've kind of touched on this in a few different areas already, in this chat. But ultimately, there is going to be more issuers that are continuing to chase this trend that we're seeing in that uptick in flows. And there is an expectation, at least of the asset managers. What happens in reality, we'll see. But the asset managers are looking at this as an opportunity at this point in the market cycle to try to pick up some of those flows, capture investor attention, and ideally outperform the market. So those products are going to continue to attract, again, a lot of attention from a marketing standpoint, and you're going to see a big percentage of the new launches certainly be actively managed.
Well, we talked about zero-data expiration option ETFs a few months ago. That's 50% of the option volume right now. I have grave concerns about this. I don't mind professional investors playing same-day expiration options, but when you start dragging in the retail community, I get a little worried about it.
It'll be a similar education to the triple levered ETFs when they came out, and at least that lesson's been learned once. So hopefully that lesson will be learned.
We know. Come on, how many? I've been here 33 years at CNBC. The one thing I learned is there's always new people coming in who have to learn the same stupid things that everybody else knows already, but they have to learn it over again and make mistakes. That's what's depressing about the whole business of living in general.
I think we just had a Forex ETF launch, or an ETN. So it's, again, you're just going to continue to see more of those products as well.
Any thoughts on 2024?
I think where the trends are, I mean, obviously we don't trade any Bitcoin at Wallach Beth, but I think the spot ETF is going to garner a lot of attention. And at the very least, it will bring attention to ETFs. There'll be people that haven't traded an ETF before, where their first ETF will be one of these, spot ETFs. So that'll be very interesting. And then really, I think it's led by the market. If we get into a overall value market, you will see money come away from the covered calls because, of course, they'll underperform. But there'll be other option strategies like the synthetic longs, where the tickers are so high that they could start to get into those products. It just draws attention to alpha.
Right. That's the point. The ETF is a trend-following business, essentially. So if the market trends up, there'll be less interest in the covered call products and more in how do you leverage the market going up, right? How would you do that?
Well, I wouldn't suggest selling naked puts, so that would be the opposite trade.
The naked put.
And I don't think that's going to come out, and that's probably not a good idea. But they'll just tinker the strategy with the covered calls and how they rotate. They're all actively managed, which is a good thing.
See, this is part of the things I love about the ETF business and what I hate about it, because I love it because the ETF business is maturing now. So it's a business, and they're always looking for new ways to attract new people. And yet, at the same time, do we really want people going out buying naked naked put.
Right.
I know you're joking, but that's not a crazy idea necessarily.
Probably not for some kind of way to cover it.
Not necessarily legal, but there's a way around it, what you're talking about.
Well, they're going to come
and that will happen.
Yeah, they'll come to him with ideas for sure.
Yeah.
I just think it's generally going to be.
Are all the good ideas gone that aren't crazy?
4 years ago, you wouldn't have thought these covered calls might have been so big, and now they
laughed at it. You're right.
I think when you mention it as a business, as long as you're saying as a business, don't forget the issuers are kind of, the bulk of their products are in these very low management fee products.
Yeah,
this is giving them the opportunity to charge 75 bips, 100 bips, 80, and it's worth it because if you're, I'm not saying that it's not taking too much. If you're a retail investor trying to write your own covered call strategy on Schwab, with individual stocks, it's really hard to do.
Yeah, all that money in short-term bonds and money markets, they're competition for dividend products. We've got plenty of dividend products that are equity products. How about any chance, Andrew, we get any inflows into normal equity dividend products, like the Spider dividend? And how about high yield?
I think you will. I think the high yield will continue because, again, the rates will at least level off in the money markets. And they're going to want to continue to get 5%. And the only way you're going to get that is equity dividends or high yield if you're going to go to fixed income. It'll go back to just the same trade we had 2-3 years ago. You'll get back. We've seen inflows into HYG and J&K and SJNK, those same names. And like I mentioned before, you have the dividend ETFs like the cows from Pacer, right? That'll produce a nice dividend. Again, we're going to have to get used to not getting 11, 12% anymore unless you're in one of these covered call products in the right market. But I think ETFs will offer. There'll be plenty of ETFs that will offer that equity. That will offer that 3 to 5% range. Of course, market risk, but the market should be rallying next year, I think. And then, of course, the high yield will kick into that kind of 6 to 8 range. But again, there's risk in those names right now in your Goldman Sachs Marcus account, you're getting 5.25 with 0 risk.
Yeah. Let me go slightly off topic. I want to ask you about T+1 next year. Those of you who don't know, the U.S. stock market next year is going to go to what we now call a T+1 settlement. So it means stocks will have a settlement date 1 day after the trade is made. Right now, the U.S. stock market has a 3-day settlement period. So this is a big technological change. The market's very preoccupied with this. So I guess, Ben, what are the implications for ETFs and the markets in general?
It's been a big initiative at the bank, and as you said, certainly May of 2024, we're going to see this change implemented. And we service over 1.7 trillion in ETF assets and run a proprietary tech stack to support all these assets and provide that servicing. It's been a huge initiative for us and the industry. What investors really need to know is really probably a couple things. One is, we think the biggest impact certainly is going to be in international equities. So if you think about any markets that will not be on that T+1 market.
Right now, Europe is T+2, right?
Right. So when U.S. moves to T+1, obviously there's a mismatch in settlement, and the potential outcome there is that you could see impacts on liquidity because of the way the market structure is designed and the way that the liquidity providers create and redeem ETFs. It also has to do with the FX and the timing of that. But ultimately, we think that the market will adapt and provide, and step in to provide that liquidity. But it is something to watch, and I think it's going to be more, again, on those international ETFs and on an ETF to ETF basis. So, again, that's probably the biggest thing that investors should be aware of.
I just want to emphasize, Andrew,
the financing
this is a good thing, going from 3 plus 3 plus 3 plus 1. And those of you who don't get confused about all of this, I'll make it simple. You want shorter settlement because this guarantees that you know that you got your stuff sooner. So if I bought 100 shares of IBM, how do I know I actually bought 100 shares of IBM? Well, there's somebody who gets in the middle that guarantees that. But they only guarantee it after 3 days. Now, if you guarantee it after 1 day, what it does is it reduces risk in the market.
It's much more efficient.
What you call counterparty risk in the market.
We've had institutional clients asking us, you can do a T1 trade. I've been doing T1 trades for a decade. And a lot of institutions over time, just more and more and more for the same reasons that you said. They want the security, they want the cash in and out. There's financing charges when that cash is stuck in the middle. Maybe it's not the best thing for some of the banks that don't get to keep that spread for 3 days, but it's more efficient for the client, for sure.
Certainly in an era of higher rates as well, that financing charge has become incredibly important.
Correct.
You mentioned Bitcoin. I got it's the obligatory Bitcoin question, folks, here. We're up 30%, we're 30,000 to 40,000, right? On all of this on hopes for a Bitcoin ETF. What's the timeline for a likely rollout? Either one of you, doesn't matter.
Look, I think, it's hard to predict. Obviously, everybody's waiting for the SEC, of course. We are in the process of helping multiple issuers get ready, again, to provide the servicing to power these products whenever they come to market. A lot of signs seem to point, and certainly all the media, seems to point to Q1, whether it's January or some point a little bit later in the year. It seems like we're getting very, very close. If you look at all the filings, and when the market's ready, we'll be ready. And I think, to Andy's point, I think we will see a lot of interest for these products whenever they end up making it to market.
Then it'll settle down, though. I think then it'll settle down. You'll get back to everyone saying, "Okay, what's the proof of concept on the underlying asset class?" And then we'll see. But certainly, there's a lot of excitement for traders and the traders in those products to be able to reflect their views in an ETF.
I want to get clear about what you guys do, because there's a reason I have been on. You're the biggest service provider to the ETF industry. But explain what that means to be a service provider. What do you do?
It means
that makes you so important.
Yeah, again, it can mean a lot of things, but certainly the way I like to describe it is we provide the infrastructure to power up the ETFs. And again, as I mentioned, it's over 1.7 trillion of assets. Right. And what does that mean? It means custody. We clear and settle trades. Right. It means accounting.
NAVs?
We value and provide
the
trade. Net asset
you
value.
Settle, right. The point is, when you're looking at the price of your ETF, they're the ones, you're the ones that actually settle on the price.
We are the golden source, right, for that price. Financial statements and ultimately the ETF creation redemption orders. So when the liquidity providers come to trade any of the ETFs we service, they're coming to our desk, and we're effectively the tip of the spear when it comes to processing those orders. So there's this gigantic
iceberg underneath the surface that you see when you do with ETFs and with stocks too. But you take care of all that stuff to make sure when you're buying that ETF, you make sure that you're there, making sure what the price is right, calculating the price. You do custodial work too. Yep. Now, for the Bitcoin ETF, you're not going to do the custodian work, right?
That's correct. Right. We are simply providing the fund services, ex custody. Right.
Okay. So I know that gets a little technical, folks, but it's an important distinction. Yep. Anyhow, the point is, you're the firm that provides all the management underneath for everybody.
That's exactly right.
It's a very important business, actually. It's really the guts of. Yeah. It's all the stuff you don't see. It's like the plumbing behind the walls at the New York Stock Exchange. Like, the place runs on massive amounts of technology, but you never see it. It's all behind the walls there. You kind of, do that kind of service.
Same thing at BNY Mellon.
Yeah, all right. Thank you. I just want to make sure people understand why I have this guy around all the time. Thank you, guys. Appreciate it. That does it for this week's ETF Edge. My thanks to Ben and Andrew. We've asked Ben to stick around and chat a bit more about the outlook for 2024 on our ETF Edge podcast. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.